Greetings, traders and investors, and welcome to the Trading Analysis YouTube channel. My name is Bennett Tyndall. It's Saturday, September 4th, 2021, and my goodness, has it been an extremely busy summer. I do apologize for the lack of public content on my part recently, but hey, if you are interested in staying up to date with us on a regular basis, you can check us out at tradinganalysis.com. I do post nightly market updates for our clients, anywhere from 30 to 60 minutes in length. And it does include timestamps so you can quickly navigate to the content that you're interested in. Additionally, you can of course follow us all on Twitter to stay up to date with what we're doing. We also post many charts on Twitter. And more importantly, we have 2 weekly live stream shows on YouTube, one of which is actually hosted right here on this channel every Thursday at 9 a.m. Eastern. We have Crypto Lab with Alex. It's a fantastic production. Every Wednesday, 8:45 Eastern, in the morning on Todd Gordon's YouTube channel, we have the entire team together for the TA Live Wednesday live stream show. We're going to have more shows hosted here soon, so if you do enjoy the content, we would ask that you please subscribe with notifications and give it a thumbs up. It allows the YouTube algorithm know that you are appreciative of the content and it distributes it accordingly. Okay, so now that that's out of the way, let's get to it. The last time we met together, we were tracking the move off the 1.75% March high in the 10-year yield. Speaking of following us on Twitter, back in March, I posted a chart suggesting that the 10-year yield would find resistance at 1.75% and start a pullback. In June, we noticed that the corrective, or I should say at the time, the price action off of the highs did appear to be counter trend and corrective. We know that counter trend corrective moves go against the more dominant trend, which is on the upside, or would have been on the upside in this instance. In fact, if you'll notice here, back on June 10th, June 11th, at 1.45%, we had a response in the 10-year yield all the way up to 1.6% or 1.59%. Interestingly enough, the 1.49% level that you see here in green demonstrated equality of magnitude of correction compared to the wave 2 counterpart or wave 2 of the same degree. The C versus A 100% at 1.47% that you see here indicates a measured move correction. We know that corrections are often equal segments. Said otherwise, if you were to take a Fibonacci measurement of the initial decline, project it from your counter trend corrective pullback, equality of magnitude of decline came in at 1.47%. That was a very interesting zone that we were watching at the time to potentially signal to us that a larger corrective pullback was going to hit the market. We had a lot of inflation talk throughout the summer, and the markets became very headline driven. But what ultimately happened here was while the 10-year yield did initially give us this move, it ultimately failed support and moved into new lows. Simultaneously, while we got this spike up in yields, the contracting price action in the S&P 500 that we looked at together did give us a bit of a pullback, but very similar to what we see here in yields, the S&P 500 broke out to a new high, and 10-year yields have broken down fairly significantly. So the inflation narrative, while it did initially spook investors and it actually sparked some risk-off rotations that we noticed in RRG analysis in Optima being one of 2 software packages that we depend on heavily here at Trading Analysis. Our research director, Terry Long, has done an amazing job spearheading our efforts here, and he posts sector analysis videos here on the YouTube channel. I would encourage you all to check them out. Very informative. He has been doing an incredible job at keeping our clients on the right side of the trends. It's been an invaluable tool to what we do here. So great addition to the TA package. All right, so getting back to the motive wave platform, while we did initially see the risk-off rotation as evident in the RRG analysis in Optima, it was never able to gain momentum or see a positive change in velocity, if you would. And for that reason, we've continued to remain focused on the hard right edge of the charts. As Elliotticians, we feel the hard right edge of the chart is your best forward-leading indicator, as collective market sentiment has proven to be expressed in pattern developments, and these patterns are evident across various financial markets dating back to the late 1800s, and they repeat. So now more than ever, we feel that is of the utmost importance. We have such mixed sentiment on the street in terms of outlook into the next year. What's the Fed going to do? Are we going to see Fed tapering? Are we going to see runaway inflation? At the end of the day, the future is very much so unwritten. And again, that is exactly why we use tools such as Elliott Wave. So let's talk a little bit about what's happened since, again, we met last. When we met last, we talked already here about the 10-year yield. I'm going to show you what I think has now happened in 10-year yields, and I'm going to show you a sign that I'll be watching for to help determine where the Treasury market is going next. So first of all, let's talk a little bit about the S&P as well as the SMH, and then we'll move into the Nasdaq. In the SMH, this was the last chart that I had for you. The last chart that I had for you and we talked about was this contracting price action, the overlapping contracting price action leading up into the June 15th high in the S&P. That did give us a corrective pullback. You will notice here the corrective pullback did find support just shy of about a 50% retracement. That pullback has since yielded, as you can see, new highs, and my 43.85 longer term price objective, which let me drop a guide on here. I just love the significance of the 43.85 level. That 43.85 level met and gave us another sharp corrective pullback. If you take a look at the dates of your pullbacks here in May, June, July, and again in August, they all sold off into finding support either the day of, the day before, or maybe the day after monthly options expiration. So we've had 4 consecutive corrective, counter-trend corrective moves. Every single one of these we have identified as a buyable entry opportunity with our clients and have suggested these as setting up for moves to new highs. So that's the S&P. In semiconductors, in the SMH, which is our primary means of tracking this particular industry group, in the SMH, this is what we were looking at in our last video. And it was one of the reasons that I was having trouble getting behind the 10-year yield count that said Jerome Powell was wrong. Inflation is very much so not transitory, and we're going to go significantly higher in yields. The SMH, we had noticed, appeared to have completed a wave 4 correction. We were looking for 1, 2, 3, 4, 5 up into this trendline resistance into about 260. Then we wanted to see a wave 2 pullback, and then we expected it to be time to get long the SMH. Taking you over to the SMH, let's go ahead and zoom in and take a look at exactly what happened. As you can see, 1, 2, 3, 4, 5 into trendline resistance, 3 waves down. In fact, we had even identified this lower support shelf as a potential bounce point. That lower support shelf did extend and ultimately proved support for continuation. And semiconductors did move up into a new high. Okay, so back to the Nasdaq 100. Here in the Nasdaq 100, looking at the 15.5 resistance cluster, this is a zone which, if we start to break it to the upside, we could be looking at a more bullish interpretation of the indexes, which would say your September through November correction was your higher degree wave 2. This is an interpretation of the markets that I've yet to officially adopt, but it is definitely one that I wouldn't fade, and it's one I would gladly begin adopting in the event that the Nasdaq just absolutely explodes through trendline resistance and through this upside resistance cluster. Now, one of the key dynamics that I need to see unfold in this market is what's at work in yields. Back over to 10-year yields, let's talk a little bit about what has happened since the Q4 2018 high. So in Q4 of 2018, 10-year yields were at 3.27%. We sold all the way off into the March 2020 low. Interestingly enough, from your March low, we have a very sizable move higher in yields to about 1.28, 1.3% here in March. We have a three-wave pullback. Your three-wave pullback was a 78.6% retracement of this advance. Then we have a rally that was more or less equal to your A wave. So this is an example of a potential measured move correction. Interestingly enough, your higher degree orange B wave almost retraced 78.6% in price and time near identically. 78% in time was March 18th, which is where the high hit. 78% in price would have been 2.07%. Now, this looks very much so like three waves off of the highs. So I'm going to delete the ABC labeling because we know if we're going to call this an ABC, we need 5 waves down unless we retrace at least 88 to 90% to call it a flat. So for that reason, I think it is more appropriately viewed as a complex correction. And I think I just broke, no I didn't. Didn't break motive wave yet. Okay, that'll do. So if this is in fact simply a series of three-wave moves, 3 waves down, 3 waves up, so far from the high back in March, all we have evidence of thus far in the 10-year yields is 1, 2, 3 waves. I would like to see the 10-year yield reject this zone of resistance near 1.39% and break lower, establishing a new low. If we break lower, establishing a new low in a 5-wave trend, that tells me that we are at least going to see this turn into A, we get a counter trend B, and then we get C lower to complete Y of this WXY complex correction originating from Q4 of 18. But if we see this 3-wave decline start to move back up into new highs without making a new low, that's when I would be concerned that maybe a larger market correction is in store. But remember, in the Nasdaq 100 and even in the S&P and in the Russell 2000, I am tracking price action as being of the same degree as from the COVID low, which means a counter trend corrective pullback in wave 2 could coincide with your B wave retracement in yields. So this would be A, we would get B. While we're getting B, perhaps the equity markets are correcting, and then we get C to take us lower. So that's the key takeaway for me in terms of yields. I currently need to see this zone of resistance fail, and I want to see the 10-year yield break into a new low. Now let me take you over to 20-year bonds, TLT being the 20-year bond ETF. Interestingly enough, we have a pretty much identical inverse pattern in development here. from your March COVID high in TLT. We moved down in A, 3 back in B, and a spot-on measured move decline in C. Said otherwise, if you were to take a Fibonacci measurement of your A wave and project it from your B wave, which you can do very quickly in motive wave, either with your Fibonacci Elliott wave integration tool or just manually drawing it out. So as you can see there, measuring the decline, projecting it from your B wave, that is exactly where the March 21 low in TLT came in. And guess what? Just like 10-year yields, all we have evidence of thus far is a 3-wave move off of the lows in TLT. I would love to see this counter trend pullback hold as a 3-wave move and start to see a move into new highs. You'll notice here in green wave 4, we found support in an ABC measured move into a 38% Fibonacci retracement of the wave 3 advance. So that's it for me. I hope you did enjoy the content. I will be posting more public updates. I do apologize for the lack of frequency. You can follow us on Twitter. Please check out our YouTube live shows. It's a great way to stay up to date with us. What else did I want to touch on in the market? So just to reiterate my viewpoint that we continue to operate in an impulse of the same degree. Let me further illustrate that viewpoint utilizing the Russell 2000 small cap chart and the MDY, which is S&P mid cap 400. So in the S&P 500 itself, if you're an Elliottician, you know that from the COVID lows, there are multiple valid interpretations of price action. Part of the reason we have such overlap in many of these corrections, I feel, is due to the lack of clear sentiment from your COVID low. That's contributed to the lack of clarity in terms of pattern developments. When you don't have a collective peak, in sentiment, then you don't have as cleanly or clearly expressed patterns indicating the market sentiment. So with the S&P 500 being a little bit subjective at this point, and even the Nasdaq 100 being a little bit subjective in that this is so very easily counted as 1 2 1 2 1 2, with us now exploding higher in a third of a third, I've got to utilize Russell 2000 small caps and S&P mid caps to really illustrate my view that we continue to remain in a 5-wave trend of the same degree. So here in the Russell 2000 small cap chart, take a look at the most recent low. And if you follow us on our Wednesday live stream, after many months of sideways consolidation, we suggested this as a potential resolve higher. Your wave 4 found equality at wave 2 pretty much exactly. Zooming in and dropping a price label onto this low, the low came in at 21.22 versus your 21.08 4v2 equality. From the rut, let's take a look at the MDY. In MDY, which is S&P mid cap, take a look at the most recent counter trend corrective pullback. In fact, I did this exercise with our clients on our strategy video update. Even looking at this on the weekly, what do we have from the COVID lows? Well, I see one clear trend establishing move, be it motive impulsive or motive diagonal. There's no point in getting into the semantics here. It's a trend establishing structure. It's then met with a counter trend sideways correction. We then have, again, an impulsive trend establishing structure. And now what do we have? Another sideways consolidation. Bringing our Elliott wave interpretation onto this MDY chart, take a look at wave 4 compared to wave 2. Taking you off of the weekly and down to the daily, wave 4 and 2 equality took place at 459.82. The actual low was 464.34. And additionally, they are very close and similar in time. This chart right here is extremely supportive of the idea that we continue to remain in a wave one or at least a same degree trend from your COVID lows. If this is 1-2-1-2, we've got an explosive bull market ahead. I'll continue to remain optimistic in the long run, but will not discount the possibility of that larger wave 2 setting in. That's it for me. We're going to go ahead and leave it there. If you did enjoy the content, please subscribe with notifications. Give it a thumbs up. Check us out anytime, tradinganalysis.com. You can also check out Terry and Alex's content on this YouTube channel as well. Thank you for tuning in. We do appreciate it, and we will see you all on the next update. Have a good one. Take care.